Hey, what's up guys? Welcome back to the channel. It seems like all big companies these days are doing stock splits. First we had Apple, then Tesla, then Google, and now Amazon. Is now the right time to buy Google and Amazon just before their stock splits? Google announced a stock split of 20-1 back in February of 2022. And Apple had a stock split 4-1 back in August of 2020. And so did Tesla. They also had a stock split 5-1 back in August of 2020. Amazon is the latest big tech company to join that list, where they are pulling down the price of each share through a 20-1 stock split. Now, before we can answer the question, is now the right time to buy Google and Amazon before their stock split? What is a stock split, and what does it mean for you, the investor? Simply put, a stock split lowers the price of each stock. In the case of Amazon and Google, the price of each stock going forward after the split will be 1/20th of its value, possibly making it more attractive to retail investors. And why is the stock price going down? Because there's more shares in the market. If a stock split is 20-1, that means the stock price drops to 1/20th of the original price because there's 20 times more shares on the market. A stock split is a corporate action that's done by the company's board of directors that essentially increases the number of the shares in the market. Now, stock splits may seem complicated as a concept, but remember, at the basic and most core level, all that's happening is that the company is taking its outstanding shares on the market and multiplying it by a certain factor. And what that does is that it boosts liquidity. Another reason why companies may do stock splits is to make the share price more attractive. Because not a lot of people may want to buy a $3,000 stock, but if that same stock that's going for $3,000 is trading for $300, that just makes it more affordable at face value. The total dollar value of those shares remains the same because a stock split doesn't really change or add more value. It's just simply taking the existing shares and multiplying it. The shares are multiplied and the price is divided by the same factor, keeping the value intact. Another way I like to think about a stock split is that let's say you have a $100 bill. That same $100 bill can be exchanged for two $50 bills or five $20 bills. You still have $100 in all those cases, but simply more physical bills in your pocket. Let's say there's a 2-for-1 stock split. Each shareholder will receive an additional share for every share that's held by them. But the value of each of those shares is reduced by half. If you have one share that may be worth $100, after a 2-for-1 stock split, you'll have two shares worth $50 each. Since the start of the COVID-19 pandemic, Wall Street has seen an influx of retail investors. At the same time, tech companies like Apple, Alphabet, Google, Tesla, and Nvidia all have risen almost impulsively, because these are the hot names that are always on the market newsfeed. And retail traders are always looking at the market newsfeed to see what are popular stocks to buy. And combine that with lower interest rates and a high demand for each of their products and services, you can see why these big tech companies are so popular. Now let's face it, if you're a retail investor who's new to the stock market, you're likely picking up names that are very, very popular. Whether you're scrolling through Reddit or YouTube or Instagram or TikTok, you're looking at what are the most popular names for you add to your portfolio. Now, picking the most popular stocks to add to your portfolio as a beginner investor is not the best approach, but that's not the topic for this video. For this video, I want to focus on the concepts of the stock split itself. And massive stock split ratios that we're seeing with likes of Google and Amazon, where they're cutting the share price to 1/20th and multiplying the outstanding number of shares by 20. This is rare, but not unprecedented. And stock splits usually happen when a company's shares have risen so high that the common investor can no longer purchase a single share. For example, with Amazon and Google, where the stock price is trading around $3,000 per share, not many people have $3,000 lying around to pick up a whole share of each of those companies. And that's where the stock split comes in. Lower the price of the stock, increase the number of shares, so that way more people can access one whole share at a lower price point. That's exactly what we saw with Apple and Tesla, and now we're seeing the same happen with Google and Amazon. And with Amazon and Google specifically, each existing shareholder will receive 19 additional shares for every one share they already own in their portfolio. Yes, that's exactly what it means. If you have 100 shares of either Amazon or Google before the stock split, you will have 2,000 shares because of a 20-1 stock split that's being held by Amazon and Google. Now, that doesn't mean the value of your portfolio will change. In theory, your portfolio value remains the same. It's just that now you have more shares at a lesser price point. Now, the share price will go up and down based on market noise, but that's what happens every day. The stock market moves up and down based on news. When Amazon announced their stock split on March 9th of 2022, the stock price was trading roughly around $2,800 a share. With the stock split, if it were to happen on that same exact day in that moment, that means the new share price will be roughly $140 a share. Even though stock splits are mostly superficial and they don't really change anything about the company, they can make the stock price more appealing to retail investors. That's really the whole concept. And that very same appeal can just mean more demand for those very same shares. Now you'll be surprised to hear, but this is Amazon's fourth stock split since it IPO'd back in 1997. It's the first time since 1999 since Amazon has announced an additional stock split. Back then it was just trading at a fractional of its market value. Here's a quick summary of all the stock splits that Amazon actually had. Let's take a quick look. It had a 2-for-1 stock split back in June 2 of 1998, a 3-for-1 stock split on January 5th, 1999, and a 2-for-1 split on September 2nd, 1999. And if you zoom all the way out, Amazon shares are up a whopping 4,300% since that last stock split was announced. If you have Amazon shares back from 1998 and 1999, you have made bank since then. For investors, the stock split for Amazon was definitely good news, as the shares are up over 5% as soon as the news came out. And to be honest with you, I'm not really surprised that the stock split happened right after Jeff Bezos left as CEO. Ever since their last stock split back in 1999, Jeff Bezos was really not that interested in either stock buybacks or stock splits. He wanted to see the share price keep going up without any interruption. Now, new CEO Andy Jassy of Amazon is definitely showing his willingness to return capital back to shareholders. And maybe, just maybe, the company starts actually paying dividends in the very near future. And if they do, mark a moment in this video that I called it out. But perhaps the most perceived benefit of this Amazon stock split is that it can be added to the Dow Jones Industrial Index, which is a composite of 30 stocks. If you don't know what the Dow Jones Industrial Average is, so yes, it's just a makeup of 30 different stocks that's meant to represent the market as a whole. Now, what's interesting about the Dow Jones Industrial Average is that this particular blue chip index isn't like the other two major indexes known as the S&P 500 and the Nasdaq Composite Index. The S&P 500 and the Nasdaq Composite Index determine their weights by market capitalization, which essentially means market price multiplied by number of shares outstanding. Now, the Dow Jones, on the other hand, which was created back in 1896, is weighted by the company's stock price itself. So as you can see, if a company has a larger stock price, it can have a much bigger weighting in the Dow Jones average. And to me, there is an inherent flaw in the way the Dow Jones Industrial Average is actually made up. I actually prefer to follow the S&P 500 for this exact same reason, because the Dow Jones is just a basket of 30 stocks, whereas the S&P 500 to me represents the 500 largest, the most powerful companies in the US. Now, because of the flaw, the way the Dow Jones is constructed, it pretty much shuts out companies like Amazon and Google, where the price has gotten up so much higher. Because at $3,000 a share, Amazon would skew the Dow Jones Industrial Average into meaninglessness. Now, while the stock split makes a better case for Amazon to be included in the Dow Jones Industrial Average, don't consider it to be an automatic inclusion. And that's because the Dow's editors, pretty much the referees of who's in and out of the index, have that ultimate decision, and it's not a simple one. And that's because Amazon is a member of the market's consumer discretionary sector. Much like Home Depot, McDonald's, and Nike, they're all representative of that very same sector, and they have a stronghold of that blue chip defensive sector. Now, in order for Amazon to be included in this index, that means either Home Depot, McDonald's, or Nike would have to get the boot. And after Amazon has their stock split, their stock price could actually be lower than Home Depot and McDonald's. And that means kicking one of those names out in favor of Amazon would actually lower the overall consumer discretionary weighting in the Dow Jones Average Index. So as you can see, taking names in and out of the Dow Jones Industrial Average is not a simple feature. It's much more complicated than that. Now, what we do know about the Amazon stock split is that it's going to bring a ton of demand, a ton of fresh demand from retail investors who are looking to get into the stock. And that in turn could light a small fire under those share prices to make it go higher, at least in the short term. Just be aware of the fact that because of the stock split, that means Amazon will likely see a lot more volume, at least initially. That could also mean a lot more volatility if you already own Amazon as part of your portfolio. So it's definitely going to be a roller coaster ride if you're an owner of Amazon and Google, at least in the near short term. Google announced back in February 2022 that it is also doing a stock split at 20-to-1 ratio. That means on July 15th, existing shareholders will receive 19 additional shares of Google, as long as you own one share of Google on the day of record on July 1st. What's really interesting is that the announcement alone drew a lot more interest into Google shares. As soon as this news got out, the stock was up around 7.6% on that very same day. Remember, nothing really changes for the market capitalization of Google. It's still just shy of that $2 trillion mark at the time of this recording. Also, another thing to remember, as a shareholder, you also have an ownership stake in each of those companies that you have a shareholding of. That means your equity stake in either Amazon or Google, in this case, doesn't change even after the stock split. Your equity share remains intact. Just like Amazon's case, the stock price will fall and the number of shares will go up, so you will balance out at the end of the day. The whole idea is that Google is just making its stock price a lot more attractive for retail investors, just like Amazon did, to increase liquidity. And if you're using a platform like TD Ameritrade or Robinhood or whatever other platform, after the stock split, you'll be able to buy more shares of Google for just less. Because let's face it, the average typical retail investor does not have $3,000 lying around to buy a single share of Amazon or Google. But after the stock split, it'll be much easier to buy more shares of Google if they're trading for around, let's say, $140 a share or so. Now, because of the trend we're seeing with all these stock splits happening, I would say expect this trend to continue for other companies. Fun fact, the S&P 500 stocks that have a share price of more than $500 in aggregate represent more than $6 trillion of market value. That means those companies make up 17% of the S&P 500. Because the whole thought process is that other companies who have a very high stock price would see a lot more retail interest if they just lower their stock price by virtue of a stock split. Let's face it, there's no denying the fact that Alphabet/Google have become a force to be reckoned with. Because not many companies can boast that their signature product or service has become a verb. Let's think of Google it. How many times have you used that in a sentence in just a normal conversation? If you don't know something, just Google it. And beyond search, Alphabet is also a leader in digital advertising. They own the world's most popular smartphone operating system known as Android. And don't forget, their cloud computing business known as Google Cloud. It's been a long time since Alphabet last split its stock. In fact, the last time this happened, the company was still known as Google. And there are plenty of reasons to believe that Alphabet or Google will maintain its upward trajectory that has led to its most celebrated stock split in history. Alphabet and Google are deeply integrated into our daily lives. Just think of all the times you use one of Google's services or Alphabet's other services. Google's search dominance remains unchallenged. In fact, 92% of all search engine searches happen through Google. As I mentioned in the video, they're also a leader in digital advertising. They own 29% of that space itself. And don't forget Google Cloud. It's part of the big three cloud computing services just behind Amazon Web Services and Microsoft. So as an investor, if you're already bullish on Alphabet/Google, don't wait around for the stock split to happen to buy more shares. There's just really no reason to wait for that stock split because, as I mentioned, the value of the company remains the same. Now, unless, of course, your financial situation prevents you from picking up a share of Google, which is trading around $3,000 a share, then it makes sense to wait until that price drops lower so you can pick up more shares at a lower price point. Now, unless, of course, if your stock brokerage that you use offers fractional shares, that might be another option that you can use. But if that's not an option, then maybe you have to wait for that stock split so you can pick up at least 1 or 2 or whatever shares you want of Google or even Amazon. Splitting the stock gives existing shareholders the feeling that they now suddenly have more shares than they did before overnight. As the stock price moves up, now they have more shares to trade with. And there are plenty of arguments whether a stock split helps or hurts investors. For example, one side will say that if there's a stock split, that could mean a buy indicator that the company is in good financial position. Because think about it, if the company's share price is increasing, it's getting out of hand for investors, they're going to drop the share price, have more shares, so more people can buy the shares of that company. Now, this may be true, a stock split itself has no real effect on the fundamental value of the company issuing the stock split, and it really poses no real advantage to investors. Now, if you're wondering whether you should buy Amazon or Google based on stock split news, I would say don't be distracted by that stock split news or share buybacks. Because if you're going to buy Amazon and Google anyways, you may as well do so because you believe in their value proposition, you believe in their services, you believe in their upward trajectory, because you believe in the growth trajectory and the value of the services they provide. That's the reason you should be investing, not just based on stock splits. Do you believe in the company? Do you believe it has potential to keep growing? Do you believe in the products and or services? Those are the fundamental reasons. After you assess the balance sheet, the P&L, you do your due diligence. Should you invest based on your risk profile? Those are all fair considerations. After all, a stock split doesn't make the company more valuable or the stock more valuable. It simply just divides them into smaller pieces. Anytime you're assessing a stock, whether it's Amazon or Google or any other stock, understand the underlying business value proposition. And if you do, you'll find that Amazon enjoys a major competitive advantage and a wide moat as the world's largest e-commerce retailer. It's also leading the cloud infrastructure service known as Amazon Web Services. And even though it's the world's second largest company by revenues, it's still growing at a breakneck pace. And the same goes for Google. It also has a wide moat around its products and services. Just think of AI machine learning. Think of Android. Think of the digital advertising and Google search engine. It has sheer dominance in the services it provides. And with the growth and advent of new technology, it's just gaining more and more ground every single day. Those are the reasons to invest in either Google or Amazon, not the stock split itself. That's just distraction in the news. Now, there is one fact that's typically not covered in the news media outlet when it comes to stock splits, and that's around options trading. And if you don't know what options are and how they work or how they're priced, I highly recommend you check out this video to learn more about options trading itself. Not a lot of investors think about the potential impact of the nominal share price on derivatives, also known as options. And that's because options are traded in the lot of 100 shares. Because you can't trade options if you only have 99 shares, you need to have 100 shares in order to start trading options. Let's say a stock is worth around $3,000. In order to trade options, you would need 100 shares. So take that $3,000, multiply that by 100. That means you would have to have $300,000 value of those share holdings in order to trade options for that company. And that's where a lot of investors get shut out, because you may not have $300,000 lying around invested in 100 shares to trade options for that very same company. Even though a stock split changes nothing for the stock itself, it has an impact on the options market. And that's especially true for small individual investors who play the options market for passive income. It's much easier to own 100 shares if the company's stock price isn't that far-fetched. Let's conclude here. A stock split itself should not be your primary reason for investing into a company's stock. Because you shouldn't think that if you buy one stock today, you magically have more shares overnight, which will be worth more. That's not how it works. While there are some very real psychological reasons why a company may have a stock split, it doesn't change anything from a fundamental value perspective. Because it doesn't change the business fundamentals, it doesn't change the market capitalization of a company. It's still all the same. In the end, whether you have two $50 bills or a single $100 bill, you have the same amount of cash on hand. Thank you so much for watching. Make sure to check out all the links in the description of this video for all the products and services I personally use, so you can get major discounts and sign-up bonuses. That's it for now. I'll talk to you in the comments section.